Do you want to deal with your crypto taxes yourself? Well, here's a cheat sheet. Now, it does require some level of expertise and skill set, but for the majority of people, you may be able to deal with this yourself. If you've been paying attention to my previous videos, you should have a basic understanding and a general concept of crypto and taxation within the UK. Now, with this particular video, we are not going to go through absolutely everything, but we will go through concepts, ideas, and steps that I would say about 95% of those in the space would be able to use. So how do you actually start the process of submitting records to HMRC? So the first step is to understand that software is your friend here. I would say in almost every situation, you should be using bespoke and specific crypto tax software. Now, there are a few options for this. It all depends on your situation, your circumstances, and what battles you would like to fight. To name a few, you've got Coinly, you've got Recap, you've got Crypto Tax Calculator. So you do have a few choices. Now, these costs do start from about £39, which is, in my opinion, completely affordable when you think about the hours and hours you would save with software. So what does software actually do? Well, it amalgamates the data for starters. It puts it all into one place because you probably have more than one wallet. You probably use more than one centralized exchange, for example. So it kind of centralizes all that data in itself. It also aids with Section 104 pooling. So what that means is every time you dispose of an asset, you need to do a calculation of what that average cost is. And there's certain rules within 1 day, within 30 days, and everything outside of that. This deals with pretty much all of that. So if you don't understand what I'm talking about, you definitely need to use software in this situation. It also deals with the data in some fashion. So the software would link transactions between wallets and whatnot in some way sometimes. So it does deal with some of the work. Now, what it doesn't do is fully reconcile the data. So if you're a business owner or perhaps you're an accountant, and I said to you, you were using, say, Xero as software, and you're in a situation where you plug in the bank statements and do nothing, how incorrect is that going to be? That's exactly the same thought process with crypto tax software. You do need some form of bookkeeping for it to be relevant and more appropriate because the data in is going to be raw. It also doesn't understand why you did certain transactions. For example, airdrops, any income from perhaps some self-employment. Maybe you've got a node that you're trying to reinvest those profits back into. And if it's considered a business, you get certain deductions there. Maybe you've got some form of burning mechanism with your NFTs where you burn one and get three back. How do you split the costs from that? Is it a disposal? Perhaps you've got some NVC, so negligible value claims to make. Maybe you're transferring assets to your spouses, which is tax-free. So it won't know these things and much, much more. So software will get you so far and it absolutely helps, but it does not do everything. Now, it might not also pull in the correct or complete data as well. These tend to rely on either API integration, which is like a bank feed, if you like, or CSV file. So it's the raw data that just is downloaded and then you upload it into crypto tax software. This is great, but terrible input will be terrible outputs. So the next step is about data gathering. Now, if you've got terrible input, your output is going to certainly be terrible in itself. So you have to make sure that quality of data is as high as humanly possible where possible. So what does this mean? We're talking about API integration into the software where possible. And then what you want to do is get the CSV files as well. And with the holes in the API integration, because there will be some, you want to cross-reference it to the CSV file, and then the holes should be plugged using the data from the CSV file. This is in a perfect case scenario. Maybe you can't get the CSV files, maybe you can't get the API integration, but by using both, you tend to get a better set of data. Again, it depends on whether what blockchains you're talking about in a lot of cases. Please, please, please do not upload both because you will have a duplication of data and it's just going to throw everything off as well. You may be able to integrate the data through an API key. And then if it were to break, you can upload CSV files on top of that. It is possible, but be very careful with that because the chances of overlapping data and therefore duplicate data or even missing data can be high in these situations. The other thing you need to know is that with centralized exchanges, so SEXs, the API integration is great, but it tends to break after 12 months. Now, The usual culprits for this would be Binance, KuCoin, Mexi. I don't even know if you can get an API integration anymore. Bybit and Kraken as well. Coinbase, Gate.io maybe sometimes. So what you need to do here is grab the CSV file if the API doesn't work. And if they do work, they will only work for a certain amount of time. The next thing about data is get every single wallet, every single exchange that you had. You might say, oh, I've only got £5 in this particular exchange or wallet, and it's not relevant. But if you've had even £10,000, £1,000 going through that wallet, you're going to miss that audit trail. You're going to break that connection from where it's come from and where it's going to, and it's just going to be an absolute world of pain. So please do include absolutely everything that you can and think you can find. Sometimes you're in a situation where no data is actually available. So what you're going to have to do is the best that you can with the information available and the tools that are available today. So in certain situations, you might find that you don't have the data, so the base costs will be effectively zero. Now, what this means is your tax will increase because of this. So as long as you make the right disclosures to HMRC in your tax returns when you're dealing with this, it shouldn't be an issue. You are going to be overpaying tax, unfortunately, but you are just doing the best that you can. A frequent question I get as well is to do with shared wallets, whether it's a friend, a spouse, family member. Just don't do it. I promise you, the headache involved here is just going to far exceed any form of benefit you're probably going to try obtain through this. Your best bet is to keep wallets as clear as possible in terms of who owns it. Now, it's not the end of the world if you do that, but it'll be more of a pain in the backside for you to deal with. And if you try and claim to HMRC that it's a shared wallet, portfolio, whatever it is, they may question it. They're not too keen on this. So you may have to prove that you have got some form of deemed trust, or maybe even an actual trust involved. Perhaps you've got a declaration of trust, for example, or something more formal in place to state that it is actually shared between two people. The next thing to note is multiple networks on a wallet. So for example, if you've got an Ethereum wallet on MetaMask, you may be bridging between different networks with or without realizing it. And what this means is, although you are uploading your layer 1 Ethereum wallet with that address, you may have layer 2s on there as well, which needs its own upload. So let's say you've got some layer 2 like base chain, for example, you'll have to upload that separately in some situations. Some software like Coinly may pick up other networks when you upload the one wallet address, but please be very wary that you need to see all the different networks on the software itself. You can probably tell this is the biggest battle in the entire process, is trying to get the correct and appropriate and sufficient data to start with. So spending some time here will absolutely offer you some form of dividends in the future, maybe tenfold your time in savings. So once you get all the data on there, as mentioned earlier on, the reconciliation itself is the most important part. So let me give you some pointers towards where you want to look in order to ensure correct and appropriate reconciliation. The first one to remember is that you will need to merge transactions, especially if you're involved in DeFi or meme tokens. There will be transactions that don't quite work with the software and they don't interact and link the two, one against another for example, and you'll have to go in and merge those itself. So be very mindful of that. The second one is to look for transactions that don't quite make sense. So perhaps it goes somewhere where there's no destination, or the destination is a wallet address that may be yours, so you've missed a wallet, or maybe it's some form of DeFi protocol and it's going there, or is the software not picking it up appropriately? And this is becoming more and more common with those in Web3, because if people are starting, say, in 2020, after 5 years as of recording this, you're going to be a lot more comfortable with diving deeper into the ecosystem. The next two to look at is the missing base cost and the missing purchase history. So when you've got a missing base cost, what it means is there is no cost associated with that particular disposal. This will inevitably increase the amount of tax that is due because the cost itself is lower than what it should be, i.e. zero in this case. So you absolutely want to find these because it's probably going to reduce your tax bill. I can't imagine a time when it won't, to be perfectly honest. The other one I just mentioned is the missing purchase history. So this is when you sell more tokens, coins, than you actually have according to the system. So in this case, you would sell, say, 15 ETH, and you only had 7 to sell. This is a strong indication that you are missing some form of data. Maybe it's a whole wallet, maybe it's a particular layer, maybe you're just missing chunks or months or whatever it might be. So it's a huge indicator of missing data right there. The next one is tags, you want to start looking through everything that isn't tagged to something. The important part to note here is that not everything needs to be tagged, but a lot of things will need to be tagged. Now, what are these tags? Maybe it's a cost. Maybe it's an airdrop. Maybe it's some income of some kind because you work in Web3 and you are paid in, say, Bitcoin. And these tags will enable the system to determine the tax treatment itself by having predetermined allocations within your accounts simply by tagging. Now, speaking of airdrops, this is another big one that people always ask, and it is down to the individual airdrop and that individual situation, to be perfectly honest. And there is a toggle in the settings in some cases where you can determine and set if it is taxable upon receipt or not. Now, I know many of you will be rushing there to go, yeah, I'm turning that off, but that might not be appropriate. And you might be accidentally evading taxes here, which I would not ever obviously recommend. Liquidity pools is another one you'd probably want to check while reconciling because these can have its own issues. If you don't know what liquidity pools are, then you probably don't need this section, but they can be somewhat complicated to account for. So definitely something to pay attention when you're doing your own bookkeeping and reconciliation. Another one is to determine the potential loss of beneficial ownership with DeFi protocols. Now, with staking, for example, you may be in a situation where you lose beneficial ownership upon entering said protocol. With LPs, might be the same thing as well. With loans, and I get asked this a lot, whether taking a loan out is a great way to avoid paying taxes. Not in most situations. For example, that I found and come across anyway, you actually could lose beneficial ownership upon entering into a contract to have your, say, Bitcoin liquidated, with to not make payments or certain conditions are met. The final note I would say when dealing with the reconciliation is to actually have a look at what you're doing and determine if it is a trade or not. Now, why I would do it here is because one of the questions with the badges of trade is the frequency of transactions. I would always make it relative to the industry. So those in Web3 will probably dispose and acquire a lot more assets and frequency of assets than, say, someone who's trading stocks and shares. So with the badges of trade, I will definitely review that. There's a set of 9 questions to determine if you're a trader or not. HMRC have stated that they are quite adamant. It's unlikely for someone to be a trader in these situations, but for those watching, you might be that 1 percentile that is actually a genuine trader. The most common one is if you have an NFT project, for example, that's probably going to be a trade, or maybe you have your own coins or tokens when it becomes more of a business, if you like. Just by having an absolute enormous amount of trades, say 10, 20, even 30,000 per year, doesn't necessarily automatically make you a trader. The next section is about making claims. Now, the big one is negligible value claims. This you have to make in the actual tax return itself. If you have an asset that is underperforming, or you can't get rid of, or there's no liquidity, or the gas fees are too high, or you just, as long as you meet the criteria, which is it is unlikely to ever bounce back and it is of negligible value, there's no exact definition of that, you can make these claims as if you sold the asset, crystallizing a loss, because as we've mentioned in other videos, a gain or a loss is only crystallized at the point of disposal, when you lose beneficial ownership. So if you still have ownership of an asset that is sitting at a loss, you're not going to be able to crystallize said loss until you dispose of it, unless you make an NVC, a negligible value claim, where it's deemed as a disposal at 0 and it's bought back at 0. But just remember, there are criteria that needs to be met on this. And if you ever do sell it and it does go up in value, which is unlikely, then you're going to be paying the taxes back on the amount that you saved and everything else. So it's a full amount that will be taxed at disposal. Losses is another one to think about when making claims. Now, you can use losses that you've locked in, capital losses that you have locked in with HMRC at any point. You do have 4 years to claim them and lock them in with HMRC, but once they're locked in, you can use them at any point. So please do make sure you remember to use the losses if you can, and you do indeed have some. Now, the last thing I want to mention about this sort of area of making claims, etc., is about making sure that we're claiming our expenses, especially for miscellaneous income. Now, this will be your staking, your rewards, maybe it's your airdrop income if it is taxable upon receipt. You might have some expenses here. Please do claim those. But if you do not, or they are under £1,000, you may be able to make a claim for the trading allowance, which is £1,000 tax-free. So make sure you assess that, because it might save you just a little bit of money and make a big difference once you start stacking these little savings. So the next part is about populating the tax return itself. Now, it does depend on what software you use or whether you're using HMRC software, but I'll try and keep it fairly broad. So the first thing I want to talk about is where to put it on the tax return. Now, prior to the 24 to 25 tax year, which is the current year that we're dealing with, because it's just passed in April 2025, prior to that tax year, you would have had to include it in the other property asset and gain section under CG1. This is the most appropriate box in my opinion, and it will ask you for things like your proceeds, your costs, the number of disposals, and then it'll help you calculate it, which is absolutely fine. However, from the 2024 to 2025 tax year, there's a new crypto assets section under page CG1, and this is where you'll need to put your new disposals and acquisitions and the cost, etc., into, rather than the previous box that says other. So it's a specific box for crypto assets, which is fantastic. Please remember that with the 24 to 25 tax year, there's also a change in tax rates partway through the year. So you will have to make an adjustment for that, where it went from 10% to 20% to 18% to 24%. So the way it works is it takes the entire figure for the year, calculates it at 10 and 20% accordingly, depending on what your marginal rate of tax is. And then you have to put in an adjustment to say, actually, it's, I don't know, £7,000 more, as an example, because part of your portfolio was actually disposed of post 30th of October 2024. So that's a bit of a complicated section there. However, I'm not quite sure what HMRC's website looks like and how to deal with it there, because we have our own software that we pay for and use, which most accountants do. But it should simply be a case of running 2 reports from your software, one for the whole year and one for the period after, so that you know what the split is in itself. The last thing to remember is, please don't include your annual exempt amount as a deduction. Okay, so this is an allowance. It's £3,000 at the moment for the 24-25 tax year. It's the amount that you can have tax-free as a gain. Do not add this additionally. There'll be a box somewhere or somewhere to tick to say you want to use it, or maybe it's just automatic depending on the software that you're using. So please don't add it specifically as an expense, because it's not an expense, it's just an allowance. A couple of final notes here just to round off, to really get you thinking, is if you're involved with Hyperliquid, for example, there's a special way to include that data within the software. And it's not just Hyperliquid. There's other situations where you need a certain way to include the data in an easy format, and there are tools out there that will help. And the second thing as well is, if you have Solana NFTs, which I know a lot of you probably do, you may actually be disposing of the NFTs when you put them up for sale and reacquiring if you take them down for sale, because of how they work, unlike, say, Ethereum based NFTs. So just because they are also NFTs doesn't mean they're treated in the same way in this very crucial part of tax, where a disposal means there could be taxes to pay or losses. So let me know your thoughts in the comments if you have any questions, if this is helpful or not. And I promise you, if you understood absolutely all of this, you can probably do a half decent job with reconciling the data and then subsequently reporting it to HMRC. Now, don't get me wrong, some of these things can be extremely complicated in practice, but just by being aware of them, you might be able to figure it out. And depending on your portfolio, of course, you may be able to do it yourself. But if not, please do reach out, because anyone who is a subscriber to my YouTube channel will get a 1-hour free consultation if you need it. So it's not just for you and I to have a chat, as much as I'd love to. I'm a very busy man. But if you need our services, the consultation will be free for you. So let me know what your thoughts are. Please do hit all the like buttons, bell icons, comments, the whole lot, so I can continue to make content for you that hopefully will be of use. Until next time, cheers.